You found a stock that you believe is the next Tesla, a 10-bagger if you ever saw one. There's just one problem. You can't afford the shares. So you're just gonna have to miss out on those juicy returns, right? Wrong. There's a way that you can benefit from the stock's big moves at a fraction of the cost without even owning the shares. And it's this young investor's secret to taking his portfolio to new heights. He's here to show us how it's done. You're watching Inside Investing. Hello everyone, welcome to another edition of Inside Investing, your guide to leveling up your investing skills with perspective from savvy DIY investors and financial pros. Presented to you, as always, by TD Direct Investing. I'm your host, Rob Moise. And Options Trading Month at TD Direct Investing is in full swing. We're helping you learn the basics of options trading and what it can do for your portfolio. Head on over to td.com/OEM for a full list of events going on this month. Today, we're going to hear how buying options can help long-term investors accelerate the growth of their portfolio. Joining us is Bilaal Dhalech. He is the founder of BD Investing. Bilaal, great to have you back on the program with us. Always great to see you.
Always great to be here.
So, you were on the show not too long ago telling us about this ambitious goal you have to be a millionaire within the decade or so. How do you think options trading is going to help you do that?
Well, options, it allows you to expedite that because, you want to own so many companies, but you want to move the needle. I can't own 100 stocks. My portfolio, I'm trying to keep it at 20 to 30 long-term bets. So options lets you kind of make those side bets and kind of expedite, allows you to make more money on your smaller bets.
Mm-hmm, right, you're essentially using less capital to get the leverage that it can provide and hopefully get some gains off of that. I'm curious, how much has options trading already helped you accelerate the growth of your portfolio?
So I've been trading options for the last 2-3 years. I think I kind of mastered it this year. So this year alone, I've already made about $20,000 in just long-term option contracts. So that's kind of really pushed this portfolio very further, and I'm getting closer to my goal of $1 million.
I have heard things like there's a certain market tuition to pay, though, when you're learning how to do any kind of active trading. How much was your market tuition as you were learning the ropes?
So since I've been trading the last 3-4 years, I've probably lost almost $8,000 to $10,000. And this was in the beginning stages. I still incur a couple losses here, but it comes with practice where you set your stop losses. But yeah, in the beginning, almost $8,000 to $10,000 kind of made me give up options for a bit, watch some videos, practice a little bit on paper trading. But hey, we're back in the game, and it's part of the game.
Yeah, glad to hear it. I think a 20K gain, I think a lot of people would sign up for that. Pretty good. And hey, 8 to 10K, that's cheaper than a university degree. So hey, it's not the worst. So I know you do long-term investing as well as some trading. And I think a lot of long-term investors would kind of look at this strategy that we're going to talk about and think like, okay, maybe I could dip my toes into the options waters here too. That said, how does the mindset of a long-term investor need to change when they're trading options the way that you do?
You definitely need a stomach, and you need some, a lot of time in the market before you venture into this, because this is kind of a more advanced strategy, but more advanced in the terms of your emotions. So if you're someone that can handle emotions, handle volatility, handle seeing your portfolio do big swings, then I definitely think you can venture into this. However, people need to understand the risk of options trading as well. Like I said, huge swings, huge volatility. I feel like the problem social media and the world and movies like, The Big Short they romanticize day traders and day trading, but they don't understand that there's a lot of emotional sacrifice you got to make into this. But if you can handle it, if you can handle seeing big swings in your portfolio, I definitely think this is something long-term investors should incorporate in their portfolio.
Okay, well, let's get into it. Let's find out how you're doing it, how you're buying options to level up your portfolio here. And for those in our audience, if you want to get in on this conversation, we've got a live Q&A with Bilaal later in the show, so make sure you get in on that. You want to make sure that you submit a question or a comment to us because you could get your hands on some sweet options education swag. We've got some TD branded mugs. We've got hats with options inspired catchphrases on them. And my personal favorite, a desk mat with options terminology and strategy all over it. It's a great little cheat sheet for you right there on your desk. Lots of great stuff that will find its way to a lucky few. So if you're watching on Webroker, you can use the chat box to send your question to us. If you're watching on our broadcast platform, use the questions and comments box. And if you're watching on our YouTube live stream, there's a link in the description that you can click on that will take you over to the broadcast platform, and that's where you can ask your question. Okay, Bilaal, so let's get into your strategy here of buying options. And you're buying a special type of option called a LEAPS, and you're buying LEAPS calls. So take us through what is, a call option obviously, but also what is a LEAPS call option?
Yeah, so what a leap is, it's a long-term expiry contract for options, and what you're doing is you're basically buying a contract on a stock that, in this purpose, you're bullish on long-term. So a leap is something a contract that would expire about six months, 12 months, 1 year, 2 years, 3 years. So it's very long dated. You're also trying to aim for a strike price that's a little bit out of the money. If you can find something in the money, which will be a lot more expensive, but much safer. But then again, since you have the privilege of having more time on your side, you can aim for more out the money options call, and that will generate you much more returns because it's added leverage. So an example would be, let's say a stock, and this is just an example. Let's say a stock moves 10%, you could possibly return 100% return in a much shorter time versus holding that stock for a longer time.
Mm-hmm. And the idea here is like a call option obviously gives the buyer the right to buy the underlying stock at a certain price for a certain period of time, and they pay a little bit of a premium to the seller in order for that privilege, like as you put it. And a leaps is basically just like a longer term expiration of a basic call option. There's no difference beyond that people would need to know.
Yeah, exactly. It's exactly what you just said. It's just longer term. And it's less expensive than actual stock because let's be honest, if you really want to move, like my portfolio size is over $500,000, buying a stock that I'm bullish on and adding $1,000, it's not going to move the needle, right? It's maybe, okay, the stock maybe goes up 100%, that's only probably going to return, maybe it's only going to move the needle in the portfolio so much. $1,000 is not going to do me any justice. Versus when you buy a leap, well, you get more leverage added to that. You can get a way bigger return. So your $1,000 on an actual options leap, that could even, like I've had a contract where I put $1,000 and that was almost a 500% return. So $5,000, now that's what's really going to move the needle in the portfolio, right?
Mm-hmm, yeah, particularly with the amount of money that you're putting down to get exposure to that contract. So that's really exciting. You did throw out some options terminology there that I think people are going, what the heck are you talking about, man? What are some of the things that people need to know when they're going to be buying options like you? Some of those key terms that they need to understand.
So let's start off with the basics. When you're just looking at an options tree, when you're just looking at a regular contract, right? Something you pull up. So first, you have the strike price, and that's the price where you think the stock will move to. Then you have the expiry date, and that's your time frame of how long you're going to be holding that contract. And then you have either two sides of the trade, which is a call or a put. So just to simplify, you would buy a call if you feel like that stock will move up, and you would buy a put if you believe that stock will go down. Obviously, this is very simple. You'll have to, I'm sure you guys will put the right terminology up there. And then obviously, what else is that? I think, yeah, and then obviously you have the stock ticker.
Sure. You also mentioned in the money, out of the money. What is that stuff?
So in the money would be, so when you buy in the money calls, that means the stock, you're buying that stock where it's below the actual strike price. So let's say the stock price right now is $20. You can buy an in the money options call at $15. That is a much safer contract, I would say, but you would obviously be paying a more higher premium price because you're paying more for safety. Mm-hmm. Now, out the money, this comes with more leverage. This would come with more volatility, so higher risk, higher reward, but it's also the same, right? You could experience a larger downfall. And out the money, so an example, if the stock price is currently trading at $15, you can aim for a $20 or $30 strike price, and that would mean it's out the money. But again, higher risk, but higher reward.
Okay, now you've given us some examples, but I want to put a picture to this because I'm a visual learner, and I'm sure a lot of people are too. Can you, walk us through a very simple example of how like buying a call option would work, a leaps call? And we have a graphic that we can put up that can kind of just easily show this. But walk us through like the numbers here that we're seeing.
Yeah, on this chart right here?
Right here on this.
Oh, okay. So a simplified example of how buying a call works. Basically, when you're actually going on the options tree, when you're picking a stock, let's say the current price is $100, you could go on the options tree and set a strike price at 120, 150. Obviously, you'd get the price of the premiums on the options tree.
Mm-hmm. Yeah, right. And then the idea here is like as long as the price that you get, the stock moves to, is beyond this break-even point, which will be like whatever fees you paid plus the strike price that you chose, you will make money, basically. That's the idea.
Yeah, exactly.
Yeah. Anything below that, you're not going to make money. We can't always be a winner.
The great thing about options also is you only lose the money which you put in.
Right.
Right. And in this case, an options contract can go down to 99%, or you completely lose all of it, or expires worthless, meaning if you put $1,000, if you put $500 in this options contract, if that stock decides to fall down, it doesn't work out for you, then you will lose that full $1,000 either by expiry or way before if the stock crashes almost 20-30%.
Right. But I mean, the nice thing here, I think for options newbies is that you're only going to lose the money that you put in, as you said earlier. So like you have a very risk-defined trade here, as they might call it. So you told us a little bit about your strategy, but essentially what you're doing sounds like what would be called like a stock replacement strategy. Kind of walk us through your thinking with Leaps.
Yeah, that's kind of what it is. So the way I use this strategy is, let's say a stock that I really like, maybe a blue chip company. My strategy is, if I like a blue chip stock, I'll give an example. Can I share some tickers here?
Yeah.
Let's say a stock like Microsoft, right? Amazing company, it's a blue chip, it's one of the Magnificent Seven. Right now it's currently down almost 20, 30, at one point it was down 40%. Now for someone like me who doesn't want to own Microsoft long term, I still see this as a great opportunity for a swing trade, because Microsoft is not going to stay down forever. At least I don't think so. I think Microsoft is a great company long term, right? So what I would do is, since I'm a trader, I would take that opportunity. Instead of buying that long term in my portfolio, I would buy a Leap contract on Microsoft. Now I'll go through the options tree, I'll try to play around, see which premiums are cheaper, which one's worth it. Like sometimes it can be expensive, but if I can buy as close to in the money, the better, because that's much safer on the long term. So I try to aim for a 1 year, something 1 year out, as close as I can to the strike price. I typically try to aim for 20% from the current price. Let's say if it's $100, you aim for a 120 strike, maybe 150, something around the ballpark 1 year out. And that's typically how I try to find stocks. I typically try to find undervalued stocks, blue chip companies, sold off tech stocks that I think will survive in the long term.
And we're going to have like an example of a recent trade that you did, and we're kind of going to talk through why you did what you did and all that kind of stuff. But before we get into that, just give us a sense of like how much money do you think somebody would need to start with if they wanted to buy Leaps calls like you're doing?
I think just to get your feet wet, like you can buy a contract as cheap as $100. Typically, that's usually on more smaller cap companies, like something that's trading at $10. If you're looking for something to invest in, like a Tesla or Amazon, obviously the price of the stock is higher, so you're looking at a more expensive contract. But typically, I've had some luck trading around $500 to $1,000 for a contract, especially a Leap. Now you can always go for a 0 DTE, which can be as cheap as $50, but obviously that comes with more risk. So I've learned the more money you put out, the much success you'll have trading options.
Yeah, and just for those watching, 0 DTE being 0 days to expiration.
0 days to expiration.
Essentially the exact opposite of what you're talking about, Larry. You have almost no time to make a
I started off trading 0 DTE. You get your wins, you get that dopamine, the quick dopamine rush, but in the long term, you're going to start incurring so many losses. And remember, as your wins compound, your losses compound as well, and then it's not going to look too pretty at the end of the year.
Right, okay, so people are taking a different approach now, perhaps like you're doing right now. Let's get into an example. Take us through like a good profitable trade that you did. I believe it was on the ticker GLD Gold, which is an ETF. Walk us through this example. How did it work out for you?
Yeah, so we'll look at the chart here. So gold this year did amazing. This year had a nice run. It's kind of slowing down right now. But because I looked at the macro beginning of the year with the president and with inflation, we had a lot of uncertainties. So gold was an excellent trade that we entered. Just based on technicals, I like to use the 50-day moving average, the 200-day, and sometimes even the 20 for a more shorter time frame. But over here, if you look at the chart, I actually traded based on the 50-day moving average. So beginning of the year, we saw that gold I saw the huge run up in gold. I didn't want to chase at the top here. So instead, what I did was I waited for it to test the 50-day moving average. So we saw gold come back down all the way to the 50-day moving average. Now I was waiting to see, maybe it holds the 50-day moving average, maybe it goes down to the 200. Either way, I was going to buy either at the 50-day or I was going to buy the 200-day. This is probably the best indicators and moving averages I like to use when it comes to trading Leaps, I would say, versus day trading. It's just a little bit more easier, follow the moving averages. So either way, we saw it tested the 50-day moving average, then it reclaimed it. So I decided to enter somewhere around here. Yeah, exactly. I entered at the 50-day moving average, and then we rode it all the way for, I believe, a 16% gain from the bottom of where I entered. and I believe the leaps actually ended up being 300%. Now the leaps was for the expiry of at the end of 2026. It was just a 1-year leap. Then I don't want to say I magically like it seems like okay you got the top and then you sold the bottom. It did kind of run for a couple more days where I was like, oh, I sold too early. I did end up having a runner, and what a runner typically is I had about 5 contracts for gold. I ended up selling 4 of them. I held one. It fell down a little bit. I pulled back 50%. I ended up exiting it, and then we saw gold ride all the way back down. But this time, it went all the way down to the 200-day moving average. I was waiting on the sidelines a lot, just looking at gold. I was like, maybe it's the right time to buy. And then one of these days, I believe gold fell almost 10 or 15%, 10% on a single day because of all this options volatility that was going on. I said, you know what? I'm not gonna skip out on a day where gold is down 10%. So I decided to enter again at the 200-day moving average. But this time, what I did was I just used the same options contract as I did previously, rinse and repeated, because there was no change on the leaps. I entered the same exact leap. Then we kind of saw that ride out, but then I kind of got nervous because we saw it reject the 50-day moving average, which acted as the resistance. And I watched it fight that 50-day moving average continuously, and I was like, you know what? I got shaken out of it. I was like, I'm just gonna take some profits, go cash for the meantime. I believe there was some news with Fed Warsh going on, a new Fed going on. So I was just like, you know what? If they're gonna raise the interest rates, there's no point of holding gold at this point. Decided to exit it, and yeah, still we got 100% return on those leaps, so I couldn't complain.
That's some pretty tidy work, I think, and I appreciate you walking us through the chart and how you decided, when to get in and when to get out. Using the moving averages, I think that's like a nice little rule of thumb that a lot of people could pretty easily get. I'm curious, why did you even choose GLD in the first place? Like, what was the rationale behind that?
Well, it's kind of expensive to trade gold itself because gold is trading at like $5,000, $4,000, $5,000.
Right.
So we used an ETF that had more liquidity. Some ETF like GLD is widely popular both for long-term investors and traders. And we also saw that there's a lot of options volume. So first of all, there's 2 things I like to look at: volume and options interest. Options interest basically means the amount of people that are holding that contract, and then volume, of course, how many people are trading at a time. So because it had a lot of liquidity, meaning I can exit without having to wait, and it's easier to sell, it's easier to buy. So GLD was a more popular ETF, more volume, more options interest. Decided to trade that ETF versus something else.
Mm-hmm. Yeah, you want something like really liquid where if I want to get it in and out at this price, I'm going to be able to do it, basically. Yeah.
Exactly,
okay.
yeah.
So then what about the Greeks? Because I know this is something that a lot of options newbies are like, whoa, I don't know what's going on with the Greeks and stuff like that. What Greeks do you pay attention to, and like what are you looking for when you're lining up a leap?
So I'm not super advanced when it comes to options Greek. I try to keep it simple. I look at a couple things. Number one is theta, and I like to say this is time decay. So theta, if you have a time decay that's very high, then you most likely will lose more premium on the contract. So I'll give an example. Let's say I'm holding a contract that has a very, very risky theta. All right, the time decay is very risky. And let's say that stock doesn't move for months. It just stays flat, up and down, moves a couple dollars every single day. Well, the stock will stay where it is, but then you'll lose at least 10 to 20% on your premium because of the time decay. The time it takes where it's doing nothing, the contract starts decaying, losing its value. Now, this is something you have to pay attention to because you can still be right, and let's say the stock hits the strike price, but you'll still lose money. Number 2, I like to do delta. Now, this is the price the stock will move based on every single dollar value. So if a stock moves $1, and if you have a delta that's close to 1, I'll try to mimic the same price movement as the underlying stock. And those are the 2 ones I typically try to pay attention to the most.
Mm-hmm, okay. And then how do you know when to take profit, right? Because I mean, you had some pretty great gains there, but yeah. I think a lot of people would have gotten shaken out a lot earlier. So what's your rule of thumb?
So my rule of thumb, if I'm trading option leaps that I am not too bullish on, something I'm very skeptical on, I try to keep profit limits at 20 to 40%. Now this is something where I'm trading in the time frame of 3 to 6 months. Versus when I'm doing something 1-2 years out, and if I really like the stock, let's say we'll use Microsoft as an example again. It's down 40%. If I gain 20% from the actual stock price and I still know that it still has another 20% to move up to all-time highs, which I know Microsoft will eventually go to all-time highs, I'll trim some profits at 40%, 50%, but I'll still hold majority of my position to wait for that full recovery in the stock, right? But sometimes if I'm uncertain with a stock, I like to use a strategy called leaving a runner, right? Let's say we have something a little bit more risky like SoFi, it's a more mid-cap, small-caps company. Things can change like this with news. What I'll do is I like to take profits around 40%. That's honestly, 20 to 40% has always worked out for me since I've become a trader, and I've been like just trying to hammer this discipline into me where if it's a 20 or 40% profit, I'm taking that profit and I'll leave a runner. And what a runner is you just leave a couple contracts just to kind of see how far the stock or your trade can go. And honestly, sometimes I've trimmed the position at 20 to 40%. I've left the runner, I'll come back and it'll be up 100%. So it's kind of like a little sweet lollipop, I like to say, you get at the end of the trip.
Yeah, a little bit of like a lottery style trade, if you will, right? Just to see like, how much you could go. That way you kind of avoid kicking yourself if it runs a lot, right?
Yeah.
There you go. Okay, so like that was a good trade that worked out for you. Appreciate you walking us through that. Not every trade works out though, of course. So like, can you walk us through an ugly trade, one that went wrong, and what happened?
Yeah, and I'm still holding this bad boy. Gave me some hope this year. We'll just open it up here. So UNH, United Healthcare, I'm sure a lot of people have heard this stock. It used to be part of Warren Buffett's position. Now he sold it. But the way I saw United Health was, let's just look at the fundamentals off the bat. It was sold off. United Health is an insurance company. It's one of the, I would say, a blue chip healthcare insurance company in the United States. We saw that the stock was down almost 50, 60% in the last, I would say, 1 to 2 years. Now, United Healthcare, I'm like, okay, I need to eventually buy the stock because I can't keep watching it go down. I kept watching it go down. I kept seeing a lot of hype on social media. A lot of deep value investors were getting to this position. And I said, you know what? Screw it. Let's enter this trade, right? So first we saw that we saw UNH make a double bottom, I like to say, because it first made this low, went back up. I was like, why didn't I buy? Then it went back down and I said, haha, I didn't buy, thank God. These are the emotions us traders look at. And then as I started seeing more, I would say hedge funds and super investors buying United Healthcare, I said, this is I can't ignore it. Again, I went back to my technicals because you don't want to buy off of emotions. You want to look at your technicals. I saw that it reclaimed the 50-day moving average. Remember how I talked about it before? I love the 50-day moving average when it comes to a long-term chart. So we saw it go above the 50-day moving average. I saw that it hit its previous resistance. And then I saw it trade back and forth for a couple of days. And I said, you know what? I can't keep watching the stock. It's time to enter. And I decided to enter around here at the previous resistance. And oh my God, I was a genius because what did it do? It went all the way back up. And at this time, I believe UNH was almost up 100%, right? And I was pretty excited. And I was like, you know what? There's so much more gains left to go. Like we could still test the 200 weekly moving average, which is pretty huge for long-term investors. So I was pretty confident in my technicals at this point. That was my first mistake. I didn't take profits. I was too confident in my technicals because I was like, this is a long-term stock. Of course, I'll go back to all-time highs because this is insurance. People can't live without health insurance in the United States. Of course, us Canadians were lucky, right? And what did it do? It rejected, I believe this is the 200 daily moving average, not the weekly, 200 daily. I was like, it's okay, it's fine. It makes sense for it to reject. We went back down, we saw it chop around, and this is where data plays a big part because now, even though I was up 100%, when we came to this part of the trade, I was still up about 30% on this trade. And because it kept going sideways for weeks, for months actually, it went sideways, this contract went back to break even. And I was like, well, darn, that sucks. Well, at least I'm still break even. Maybe I can wait it out. Unfortunately, not much great things happened with United Healthcare. We saw it go down, and I currently still own this stock. At one point, I was down 90%, almost 95%, and I almost gave up on this contract. And over the last couple of days, I forgot what news came out, but United Healthcare pumped almost 10%. And right away, I was back to I was only down 50% on United Healthcare. I told myself in the back of my head, I'm like, you know what, maybe I should cut this position and take back whatever money I had, go into something else. And Warren Buffett came out, sorry, not Warren Buffett, Berkshire Hathaway came out with their 13F filing, and they announced that they sold all their United Healthcare position, and the stock went back down 10%. And guess how down I am back on United Healthcare? 80%. So I'm back in the trenches with United Healthcare. So it doesn't always work out, Rob, but I still have another year left on these contracts. Thank God I bought 2 years on this contract. Otherwise, I would have had to completely lose in this trade. But I think next time, if I go back, if I go back to the 50%, I'll probably cut this position.
Right. It sounds like you really have to be diligent following specific trading rules and not let the emotions rule you. I think that could be like a really big thing that a lot of newbies especially would have a hard time grasping, right?
Yeah, I mean, it looks, like I said, social media and movies and Twitter, they romanticize all the winning trades, all the big ones. I've seen people on social media, I'm sure you have too, who've had made millions, retired early. Some people are retiring in their 20s, trading options, 0 DTE options actually. And people romanticize it, but no one shows you the losses, right? And this is why I'm glad I'm here. I'm glad you asked me to show my losses, because I look like a genius making 300% gains on a gold trade, right? But then I'm also down 100% on United Healthcare. So there's wins, there's losses, but as long as you win more, as long as your thesis plays out, I think it's still fine to use this to advance, to expedite your portfolio.
Right. Big takeaways, know what you're getting into and, manage your risk appropriately. Appreciate you showing us the highs and the lows of buying Leaps calls here. Really interesting stuff. And we got a lot more to get to, folks, including our live Q&A. But before we continue, if you're enjoying the show, make sure you check out TD Direct Investing on social media. We're all over it. We got a YouTube, we got a Facebook, we got an Instagram, we got QR codes on screen here that you can scan to check out what we got going on. Lots of educational content designed to help level up your investing and trading game, as well as some key takeaways from past episodes and even some sneak peeks at upcoming content too. So make sure you check that out. For now though, before we get to that live Q&A, I want to bring in my colleague Caitlin Cormier, because she's going to show us how to buy Leaps calls in TD Active Trader like Bilal's been telling us about. Caitlin, welcome to the show. Great to see you as always. Appreciate you showing us the ropes as always.
Absolutely. Happy to be here.
So tell us, how can investors buy Leaps calls on the platform?
Yeah, so Leaps essentially the same as any type of option you're going to purchase. Of course, the key thing is just that time frame, right? That extended expiry. So let's go ahead and look at our active trader platform. We're going to look at the option chain, and I have a security up here. And so basically all we need to do that's different from, maybe a shorter term option trade is scroll a little bit further. So we can see here, the further we go down, the further out we can see expiries. The second column here just shows us the number of days to expiry. So we can go all the way out till January 2028. Or, if we want to choose somewhere around, a 1 year mark, we can look into 2027. So let's just go ahead and choose, for example, 2027. And I know we kind of said somewhere maybe a little bit out of the money, so a little above where the current stock price is, maybe to make a little bit cheaper. There isn't a huge difference, in $5 and $10 when we're this far out. But let's just say we're going to choose the 145, for example. I would just go ahead and click on the ask price for whichever strike I'd like to purchase. It's going to go ahead and pre-fill the option order entry for me. I can, choose more contracts if I'd like. Sorry, I always for some reason keep hitting the wrong way. There we go. We can increase the number of contracts we have, make any other changes. We can lock in a limit price as to what we're willing to pay. And then when we're ready, we just go ahead and click confirm and send, and it'll give us that outline as to how much it's going to cost us. And of course, what our max loss would be and our max profit.
Okay, so that's how you enter the order. But let's say, you wanted to use some of those moving averages that Bilal was talking about that he uses to decide when he's going to get in and get out. How do we put those on the charts?
Yes, charting is definitely key, I can tell, in Bilal's strategy. So let's take a peek at the charting in Active Trader and how you can get those moving averages on there. So I have a chart up here, and what we're going to do is we're going to see there's like a little kind of a fancy looking F way up in the middle of the chart tool. And when I click on that, it's going to show me different studies I can add to my chart. So I'm going to go ahead and type in my simple moving average. Now, I know that there are two different moving averages that Bilaal uses, so we're actually going to add it here twice. And then the key is just to customize how many candles we'd like to use for our averages. I know he said that he likes to use like a 50 as well as a 200. So we can go ahead and put both of those on there. One thing is if we're doing two separate moving averages, we do want to indicate what we want to switch the color here to make sure we can tell which one's which. So I'm going to switch and just have to remember which is which. So the 200 is going to be the yellow color there. I'm going to click close and I will see the two of them here on my chart. So that is another key thing to remember, that you want to make sure you do that. And you can also even make them look a little kind of bigger if you want. You can go in and increase the size there just so you can see them a little bit more obviously, but pretty simple just to get those moving averages directly on the chart and customize them to the length of time that you'd like to see.
Fantastic stuff as always, Caitlin. Thank you for showing us the ropes. That was TD Direct Investing's Senior Client Education Instructor, Caitlin Cormier. And just a heads up to our viewers, if you want to learn more about options trading, again, td.com/OEM. We have a QR code on screen that you can scan to take you right there. Options Education Month at TD Direct Investing is going on for the entire month of May. We're dedicating it to teaching you about options and how they can help you get closer to your financial goals. So make sure you check it out. Of course, it's now time, Bilaal, for our live viewer Q&A, okay? And like I said, folks, there is some options education swag on the line here. So make sure you submit a question to us, a comment, even fill out the survey at the end of the show. That can be extremely helpful to your chances of walking away with something really interesting. Bilaal, I know you had, we sent you a little care package as well, too.
Oh, yeah.
If you had to choose between the hat, the mug, and the mat, what would you take?
Oh, I'm taking the mat every single day.
Yeah.
It's such a nice cheat sheet. I have it right on my computer desk. So if I ever need to look at what anything means or what the explanations are, quick cheat sheet right there.
There you go. I like it. I'm with you on that one. In any case, let's get down to business and see what we have first on tap. This one coming to us from Julian. Julian saying, for Leap's call options, when do you typically recommend taking profits or closing the position before expiration? We talked about this a little bit. You mentioned 20 to 40%, but take us through your thinking around when to take profits.
Yeah, my rule of thumb, and this is just something from practice I've had over the last 2-3 years of trading options. 20 to 40% is just something I've stuck to. Everyone has their own take profit goals, but this is something that's worked out for me both mentally and with just discipline. So yeah, 20 to 40%. If it's, like I explained before, if it's a company where I'm feeling very strong on, where I know the back of my hand, like such as Microsoft or like Amazon, some of these big Magnificent Seven companies where it's easy to understand what the stock does, then I know, and if the stock hasn't reached its all-time highs, then sure, I'll hold that for much longer. But if it's something I'm just day trading off a whim, 20 to 40%.
Mm-hmm. What about if like you get like a lot of profit really early in the contract life? Does that encourage you to kind of hang on, see if there's more, or no, you're still taking profit?
No, because I'm such a psychological trader that when I see my stock move up, let's say 20% on a day, I'm like, well, eventually someone's gonna have to step in and sell, right? Like there's no such thing as a free lunch on Wall Street or no such thing as fast gains. I always know someone's gonna end up selling. Sometimes it doesn't work out, but 9 times out of 10, I've noticed that when you have a big breakout, it's better to just take profits, leave a runner, and then hope for the best.
Okay, so that's what's working for you. Let's get to our next question then. Let's see what else we have on tap. This one coming to us from Pratik. While options can be profitable, is it wiser to take a balanced approach to building long-term wealth or use options for short-term gains and put the profits into long-term stocks? Interesting question. Yeah, how are you taking the profits? Are you just putting it right back into options or are you putting it into long-term stock holdings?
So I've divided my portfolio into separate I would say accounts. So I have my first portfolio would be my long-term investing. That's my TFSA, RSP, all that good stuff. And then I have my non-registered accounts, and I only trade in my non-registered accounts. I don't want to sacrifice any of my tax-free space. Now this is a non-registered account, and this is where I like to put my fund money, my short-term bets, more speculative plays. And what I do in that non-registered account, I do my leaps, I do my cash secured puts, I do all of that fun stuff. And I typically like to just keep it in there and I rinse and repeat that money. So obviously this is all into my one big portfolio basket, but I do all my trading in that one specific non-registered portfolio, rinse and repeat. Now why I do this was because in the beginning, what would happen is I would lose, let's say I would put $5,000 in that one account. Let's say I lose that $5,000, well that's it for the year. You had your fun, Bilaal. go back to putting your money into long-term stocks. Now, let's say I turn that $5,000 into $10,000. Well, the show goes on, and I continue my side bets on the side.
Will there be a point where, like, if the options portfolio gets like so large, you're going to be like, okay, I got to take some like risk off the table, put it towards the long-term stocks, or no? It's like you're going to keep it in that account and just see how big it can.
No, that's a good point. You know, every quarter I rebalance my entire portfolio. Like I said, actually, no, I never mentioned this. I like to keep my options portfolio 10% of my total portfolio,
okay.
right? So if it gets any bigger than 5 or 10%, yeah, I would either put that back in a bank account or transfer that. Majority of the time, I just transfer whatever profits I have into my other portfolios, use that as my more long-term gas powder or whatever, and yeah.
Right on. Okay, well, great question, Pratik. We have another one coming to us from Viv. Let's check this one out. Viv is asking, BD, you are the GOAT, the greatest of all time. Wow, there you go. What a compliment. What's your near-term strategy in this market? What do you think of covered calls on dividend stocks, cash secured puts for the income, some of those other strategies? What do you think about them?
So I was telling you, Robert, this year I actually started doing more cash secured puts and covered calls. I haven't had any luck with covered calls because covered call is a more bearish strategy. And as you can tell, I'm more of a long-term bull. I'm very optimistic, so it's very hard for me to be bearish. So I have been using cash secured puts as a way to just generate income. It has been easier. I don't want to say safer, but because you do need to have enough capital to own 100 shares. But so far, so good. I definitely think cash secured puts should be involved into your long-term strategy. And what this means is you're just, you're just buying undervalued positions. So the strategy is still the same. You're still looking for undervalued stocks. And what basically a cash secured put is, let's say you have a stock that's like SoFi, is trading at $15. Well, if this stock goes to $10, I would definitely be willing to buy 100 shares of SoFi. But still, in the near term, I'm bullish on SoFi. So what I would do is I enter that cash secured put. I'm willing to buy 100 shares if the stock doesn't work out, if it crashes. And that's basically what I use. And if it goes up, well, I just made whatever premium, $100, $200 a week.
Right. Okay. So you're assuming that, like, if it's fallen, it's essentially bound to bounce back. I mean, obviously that's not always the case, but I understand the rationale at least that you're thinking. And at least here with options trading, you're only taking so much risk with it, right? Like, you're not actually buying the position. Okay, I get what you're saying. Let's get to our next question. This one's coming to us from Bradley. How and when do you use the VIX when selecting strike prices?
Oh, this is an excellent question. So volatility index, which is the VIX, basically this will indicate how expensive your premiums will be. So if the VIX is high, that implies that you will get more premiums. So this is great for people that are doing options for income. But obviously when you're doing leaps, that means your options contracts become a lot more expensive. So obviously when a VIX is higher, I tend to enter more leaps because that means there's more volatility in the market. Premiums will be cheaper. And if the VIX is lower, closer to 10, 13, I try not to do too much trading. Because just on a psychological level, when the VIX is trading around 10 to 15, that's usually when we start seeing more volatility about to come into the market. And when we go higher than 20 to 30 or 40 VIX, that's usually when stock prices begin to become more cheaper, also when premiums become cheaper.
So you're trying to time it when, like, the VIX is on the lower end versus the higher end when you're buying these positions.
Like, as a trader, I look at like I'll talk about this. As a trader, I look at 3 things every single morning. It's the VIX, I look at the 10-year bond yields, and then sometimes I'll look at gold or oil prices because oil tends to move right now with the 10-year yields. But yeah, basically, I try to track those every single day. Based on how they're trading, that's how I will go about my day. If we're seeing not much volatility, I typically don't try to sell or trade any options. If we see some deals, well, then I'll go hunting.
Your morning routine is very different from mine. I'm usually just drinking coffee and playing Candy Crush Saga on my phone. But there we go. You're a much more educated morning person than I am. Let's get to our next question. I believe we have a twofer here. Joe and Josh both want to know this one. Do you use head and shoulders patterns in your analysis? And what are your favorite technical indicators or patterns?
Yeah, I do like to use head and shoulders, but look, I'm such a conspiracy theorist. I feel like the so market makers, they kind of want you to see those patterns and then they kind of trap you. But I like to look at head and shoulder patterns on a more longer term chart, so more of a weekly or a monthly time frame, because this will paint more of a bigger picture versus looking at a daily or an hourly. But you're right. So I like to look at the head and shoulders pattern, the inverse head and shoulders pattern, bear flags, bull flags. Those are typically what I look at. But what has really worked out for me is the moving indicators. They're much more simpler for beginners to understand. Once you master the moving indicators, and my favorite ones are 20, 50, and 200. and if you can master those as a beginners, it will be so much easier for you to time when you're doing a long-term investment and also a trade.
Yeah, lots of technical patterns there that you threw out. Certainly, we don't have time to cover all of those, but for anyone interested, like we do workshops that deal with all kinds of technical goodness. Let's get to our next question, though. We have, whoa, this is like a really complicated name. I'm not even going to try to say this one. Let's say Nagas. What's the best way to find a Leaps option stock that can help improve overall portfolio performance?
You know what? If we all knew the answer to that, we'd all be rich. But you know what? What I like to do on my free time is I like to go options hunting, right? What I do, the best way to do it is make a watch list of the stocks you would typically love to trade or you understand. Don't trade anything or don't invest in a company that you can't explain like the back of your hand, you know? It's the same as if you're doing long-term investing, it should also be the same as trading, because if that trade doesn't work out, well, you let your emotions kick in versus your actual theoretical knowledge, right? Like United Healthcare, when it fell down, I didn't panic as much as I would have if I was trading something I had no idea of, right? Because in the back of my head, in my gut, I'm like, well, United Healthcare, Buffett used to own it. Buffett owned it. It's still a great company. So a stock like that, it made me more. It helped me hold, I would say, much longer. So in terms of answering your question, what I like to do is I like to look at my watch list, you know, once or twice weekly. Then I like to go open the options tree, and I like to go premium hunting, right? So let's just use two as an example. Let's say there's Netflix, and then let's say there's Apple. Netflix is trading pretty low. Let's say the premium for a 1-year options call is only $200 for a close strike price versus Apple, which is a little bit more expensive. I'm not gonna go for the more expensive one. I'm gonna go for the more cheaper price, more fair value that's closer to the strike price. So this is something you need to master. You just need to master looking at options trees for fun, because that's the only, like, if you're gonna wanna be a profitable trader, you gotta have fun with it. You gotta really live and breathe it and kind of look at trades all single day. You can't just enter a trade because you like the stock. You gotta actually go hunting.
Well, we can tell that you have the enthusiasm and the love for this stuff, which is why we really like talking to you. Appreciate you coming in, as always, to kind of take us through your strategies. This is a really interesting one. I think this is kind of a nice way for some beginners to edge into options a little bit, particularly if they're a little bit intimidated by a lot of the other, risk undefined trades, right? These are risk defined trades that we're talking about. So really appreciate you walking us through it, Bilaal. Great to chat with you as always.
No problem, yeah.
Yeah. And of course, for our audience, we appreciate you tuning in as always. Make sure you check out next week's episode because we have another options themed one. We're going to be talking about DIY investor Eric Pan's strategy of using options to generate some extra cash, and he's doing it in a way that keeps his risk to a minimum. So make sure you watch and find out how it's done. That's all the time we have for this edition of the show. From everyone at Inside Investing, thanks for watching as always. We'll see you next time.
Have more questions? Check out the links to the right and in the description below.